Picture this for a moment. Global markets are climbing as if gravity no longer applies. Stock prices are levitating, valuations are stretching far beyond historical norms, and every financial headline seems desperate to convince you that the old rules no longer matter. This cycle is unlike anything before, they say. And for a while, it feels true, until suddenly, as 2026 approaches, something in the atmosphere changes. It's not an all-out collapse, at least not at first, but a sharp turn, a jolt, a sudden break in sentiment. A wave of uncertainty sweeps across the financial world like an unexpected storm surge, triggering confusion, fear, and frantic selling. And while the media is busy searching the rubble for explanations, you're already one step ahead. Why? Because you understand something that most people overlook. Inside every market crash lies a rare window of opportunity. What if the downturn that analysts are quietly hinting at for 2026 isn't a disaster for you, but the moment that could transform your financial life? It sounds strange, maybe even reckless. But today we're going to walk through exactly why that idea is more rational than it seems, and how you can position yourself so that a crash doesn't set you back, but propels you forward. Let's be honest, the stage has already been built. Market valuations today resemble déjà vu for seasoned investors who have lived through previous bubbles. The S&P 500 is hovering near some of the richest valuations seen since the dot-com mania. Hype around breakthroughs in artificial intelligence, robotics, and other transformative technologies has sent certain companies into the stratosphere, far faster than their fundamentals can justify. Meanwhile, under the surface, alarms are flashing. Global growth is beginning to cool. Debt, both government and corporate, is piling up to levels that concern even the most optimistic analysts. And central banks that once relied on endless liquidity are discovering that their toolkit isn't infinite. In other words, the ingredients for a major market shake-up aren't just present, they're simmering. But for those who choose to pay attention, this isn't a cue to panic. It's a signal to prepare. Before we talk about what to do, let's step back and examine why bear markets often create the next class of millionaires. When stocks fall sharply, assets that were impossibly expensive suddenly become attainable. Fear becomes the dominant force, causing people to sell without discrimination. It doesn't matter whether a company is strong or fragile. Everything gets tossed aside. Confidence collapses, investors run towards safe havens, and prices fall more than fundamentals ever justify. But once the chaos settles, those who hold two essential ingredients, cash and clarity, get to make life-changing decisions. They can buy the highest quality assets at the lowest emotional moments. They can pick up great businesses, valuable real estate, and discounted opportunities at prices the average investor will never see again. Historically, these windows don't last long, but they leave a lasting impact on those bold enough to act. So the question becomes, how could this scenario unfold in 2026? And what should you start doing right now to prepare? Let's break this down into 3 practical steps. And just to be absolutely clear, this isn't about predicting the future. It's about being ready for a possibility. Step 1: identify the areas most at risk. When a speculative bubble loses air, it doesn't just weaken the smallest or most fragile companies. The fallout spreads. Historically, crashes begin in sectors with excessive leverage, unrealistic growth assumptions, and hype-driven valuations. Today, that may point to tech companies priced for perfection, speculative stocks with little or no real earnings, or industries drowning in debt and dependent on cheap capital to survive. Recognizing where the vulnerabilities lie allows you to adjust early, reducing your exposure, hedging your portfolio, or simply stepping aside before the storm hits. Step 2: strengthen your liquidity. This might be the single most important action. It is incredibly difficult, almost impossible, to buy when everything is red and everyone around you is panicking unless you have cash ready. Without liquidity, you end up doing what inexperienced investors always do, selling into fear instead of buying into it. Building liquidity doesn't mean abandoning your entire portfolio. It means trimming positions at risk, holding more cash-like assets, and mentally preparing a pool of capital reserved exclusively for moments of extreme fear. Step 3. Know in advance what you want to buy. You cannot build a shopping list during a crash. Your emotions will sabotage you. The time to identify your long-term targets is before chaos arrives. Think about companies with durable competitive advantages, strong earnings, and fortress-like balance sheets. Consider real estate in growing regions with solid fundamentals. Think also about sectors that historically thrive during resets, distressed assets, turnaround opportunities, and undervalued industries temporarily knocked down by panic. All of these categories become available at meaningful discounts when the crowd is running for the exits. To make this clearer, let's walk through a hypothetical scenario. Imagine the market rolling into 2026 with euphoric momentum driven by AI, electric vehicles, biotech, and countless other innovations. Retail investors are still pouring money into broad ETFs, convinced the rally is unstoppable. A few institutional voices issue warnings of overheating, but those concerns are drowned out by optimism. Then one catalyst appears. Maybe a disappointing earnings season from big tech, perhaps a policy error from a central bank, or even an unexpected geopolitical shock. Suddenly the upward momentum sputters. Stocks that were Wall Street's favorites fall 30%, 40%, sometimes 50%. Credit markets tighten. Heavily indebted companies face liquidity problems. The US dollar strengthens, draining global markets of liquidity. Panic selling spreads like wildfire. But if you've prepared, this is exactly the moment you've been waiting for. While others are fleeing, you're deploying capital. You're acquiring shares of strong, durable companies that are temporarily mispriced. You're buying high-quality corporate bonds at steep discounts. You might even be acquiring undervalued real estate from distressed sellers who simply can't hold on. And over the months and years that follow, as markets stabilize and rebuild, these assets recover, often faster and stronger than the broader market. You end up on the right side of the recovery curve, while most investors are merely clawing back their losses. It's important, however, to stay grounded. Opportunity doesn't automatically equal reward. Some companies will not survive a major downturn. Some assets will never return to their highs. That's why selectivity matters. You need the mindset of a value investor, focusing on assets with the resilience not just to endure a crisis, but to emerge from it even healthier. Think about the investors who bought major banks in late 2008 when fear was overwhelming. Think about those who acquired beaten, down-travel stocks in early 2020 when the world shut down. Those contrarians weren't lucky, they were prepared. And don't limit your thinking to just stocks. Crashes ripple across real estate, commodities, private markets, and global assets. With the Financial Stability Board warning about misaligned valuations and elevated risks, a downturn in commodity prices, for instance, could trigger weakness across resource companies, emerging markets, and the lenders tied to them. This means opportunity could emerge in places most people overlook: discounted corporate debt, undervalued value stocks, distressed real estate, or traditional safe havens like gold and other real assets. So how do you structure yourself to ride, not suffer the next crash? First, keep a portion of your portfolio defensive cash, high-quality bonds, or a measured amount of precious metals. This reduces stress and preserves capital. Second, write down a list of 3 to 5 investments you would love to own at the right valuation. Set clear price targets, maybe 30% or 40% below current levels. Third, begin reducing exposure to the riskiest, most speculative areas of your portfolio. As the old saying goes, when the tide goes out, you learn who's been swimming naked. Why is this important right now? Because most investors still believe the only direction is up. That misplaced confidence makes markets fragile. When optimism is fully priced in, even small disappointments cause big reactions. I recently came across an analyst predicting the S&P 500 would hit 9,000 by 2026, while simultaneously calling the current environment a gorgeous bubble. That contradiction tells you everything you need to know. The market is pricing in perfection. In practical terms, here's what you should do: decide now what you want to buy during a crash. Build the liquidity to act aggressively when fear is universal. And above all, keep your mindset flexible. The goal is not to guess the exact date of the crash. It's to be ready when it happens. Contrarian thinking is your greatest asset. A market crash in 2026 isn't merely a threat. It might be your greatest opening. If you prepare and maintain the courage to act while others are paralyzed by fear, you could place yourself on the right side of financial history. Wealth isn't earned by avoiding turbulence. It's built by navigating through it. A crash that terrifies the majority can create life-changing opportunities for the few who are ready.